Is on endowment, as you can see from your screen. We have a presenter, Mr. Chuck Orakwe, the managing partner, Xanthos Labs, based in Austin, United States, who is going to present this seminar. I think also on this call, we have Mrs. Olafumiloye, who is the president of IGSOSANA, as well as one of past presidents, Dr. Bayo Laniyonu, who is also with us. Mr. Orakwe will speak for about 45 minutes, after which we shall have 15 minutes of Q&A. I'm hoping that at the end of it all, we would have had a good time. As they say, the taste of the pudding is in the eating. Today we shall have Chuck Orakwe serve us pudding for 45 minutes. And at the end of it, we'll see whether we enjoy the pudding or not, and we will let him know. Over to you, Chuck.
Thanks so much for the kind introductions. I appreciate it. And hi, everyone. Good afternoon, my time. I'm currently in Nigeria, but I'm based in Austin, Texas. And as you mentioned, my name is Chuck Orakwe. I'm the Managing Partner and Chief Investment Officer at Xanthos. Today, we'll go over endowment. Is a brief agenda. We'll go over the governance structure that's required for endowment setups. We go over the investment management, which is really the cost of it. I'll go through and give some examples of very large university endowments or educational academic focused endowments. And then we'll summarize. I do understand that we have allocated 15 minutes for Q&A. However, to accommodate for if I use terms that people don't understand, or please feel free to interject, and I'm happy to explain it. Okay. Before we get started, I have to share this disclaimer with everyone. Financial industry is very heavily regulated, and what I say and what I present here is entirely for informational and educational purposes. It's not an offer for solicitation or an offer to invest or take investment advice, and you should not consider it. It's not a sufficient basis for investment, right? You should not consider it and take it and run with it and say, okay, I'm the expert now. Additionally, we'll go over some historical context and insights of different asset classes and how they performed. Please do understand that past performance is not a guarantee of future returns. And of course, everything presented here is subject to change. And Xanthos Labs, the team has gone through and put this deck together to educate everybody. So with that, we'll go through the governance structure. Really, for endowments, the purpose of it is you have a mission you're trying to accomplish. And for most endowments, it's very, very long term and for perpetuity. And the governance structure is really, really critical to ensure that the resources are well managed, because of course the governance is going to change and it typically has a shorter lifespan versus the endowment itself. So the governance structure is one of those things that changes quite often, and it's important to get this right. The team in an endowment typically is very small. Most even really big ones have about a 9-person team, and it's primarily made up of the investment committee. These are 9 people with different background and experiences. That there's the chief investment officer, there's a CEO, there's a person that people that are part of the fund of the staff that they'll do the accounting and financial auditing of the investment, but they get help from investment consultants or investment managers to run the fund, the endowment. And one of the most important things is that the investment committee serve really as the fiduciaries of the endowment. Fiduciaries in this case means that you are responsible for managing that money with your life as if it is your own. And any decisions that are made must be for the benefit of the endowment, not for the investment committee or an individual staff, or it must be for the holistic benefit of the endowment. Xantos today says in a fiduciary capacity as an investment manager, we're still the SEC, in a fiduciary capacity with our clients. So this is an area that we're very familiar with. All decisions has to be made in the best interest of the endowment, as we would do for an investment advisor would do for the best interest of their client. The investment committee as well doesn't have to be people that are very knowledgeable about investment and finance. It could be various diverse backgrounds because finance is one of those areas where really having a diverse backgrounds brings in a different viewpoint that allows the committee to make the right decisions based on the current economic situations or business cycle. So again, this committee really oversee the assets, the fiduciaries, and they set the policies and the goals of how the money should be managed, and get a lot of help, of course, from the investment consultants or directly the managers that would they'll manager and monitor the performance of the assets based on the guidance given from the committee. The guidance from the committee is typically very well documented and stated in an investment policy statement. And this says, for this amount of money, we want this percentage in this area and this percentage in this area. And the investment managers and the committees, or there might even be restrictions. Hey, I don't want to invest in gambling companies, or I don't want to invest in gun companies or screens like that. But all of that helps pretty much prescribe how the fund should be managed to the investment managers. So that's the first and really the most important one. These guys, the committee is really, they're the key decision makers. Everyone else is there to support, and that's the biggest takeaway. I will go over now quickly the committee responsibilities. As I understand from Dr. Odumosu, that some of the committee, the members that is planned for IGSOSANA will be from the Finance and Investment Board. So it's great to understand that that is already in place.
Chooks,
The committee responsibility.
excuse me, sorry.
Yeah, go ahead.
Yes, I
Go
just
ahead.
wanted to bring us back because I know you started talking about governance of the endowment, but for the purposes of some that are on the call, is it possible for you to just even tell us what endowment is? What is it? What is it? What do people typically use it for? So that we're all on the same page and people are not just going into the governance of it without knowing what it is.
Yeah, so I'm exactly about to touch on that.
Okay, then. Thank you so
That's
much.
my
All right.
Yeah.
Okay.
So I've shared 9 people that make up part of an investment committee, and these people are going to manage an endowment. But what exactly is the endowment? An endowment is typically set up to accomplish a specific goal. In this example, we will say for academic purpose, for help create academic excellence for IGS. That is the goal. But that goal have to be really quantified or defined in how it will be measurable, because the endowment says, here is some financial resources. We want to manage it for perpetuity so that we have higher than average inflation adjusted returns. Say you have, just give an example, $1 million. You want to keep having that $1 million and grow it more than inflation, so that you can take some money out of that endowment and help meet your goals. That small money you can take out of it would be to support operations. It could be to build a new library. It could be to set up scholarships. And these are examples, of course, targeted for academic academic purposes. Most endowments are nonprofit. You can have an endowment for religious, like church. The Mormon church has its own endowment. They have about $130 billion or so today. And the goal of that, of course, is to foster their mission to the world. So the committee of an endowment really is really, really important, because one of the jobs is to define the purpose of the endowment. And the endowment, of course, says these are financial resources that we want to be managed over a long term, that we will take some money out of to help continue to support that defined purpose. Okay. So in the documents that are defined by the investment committee, you will explicitly state the goals, you will explicitly state the investment philosophy, and you will also explicitly state the responsibilities of each of the key staff members of that endowment in how they will manage the funds. Ms. Oluwumi, does that answer your question?
Yes, thank you.
Yeah, okay. So the second point for the responsibility of the endowment is, of course, as I've sort of touched on this a little bit, is the investment policy statement. The investment policy statement says, this is our long-term target. That target could be to grow the initial assets that we have at, sorry, give me a minute. Someone is knocking on the door. I'm not sure why, over and over. All right, I apologize for that. So the investment policy statement defines if we have $1 million, where should that money be invested in? How much is our expected historical return on an annualized basis over the long term that allows us to ensure, even after accounting for inflation, that we have enough and we're preserving the capital and we have enough to meet the spending goals of the endowment. And that also, the investment policy statement also sets, if you're thinking about building a portfolio that will help you meet your target return, say it's 8%, 10%, it will set a allocation of the weights of, okay, public equities, this much, real estate, put this much in real estate, but no more than this. It will set a guidance that for all investment managers and for investment consultants to follow to help meet that determined target of 8% over the long term. The committee as well, the IPS is not stationary, it's updated can be updated frequently, quarterly, annually, right? Based on changes on macroeconomic situations. But the committee getting guidance from investment consultants or from their on their own will help update those prescriptions so that all the investment managers must follow that enforcement of those policies. And then the last part is, of course, the committee monitors those policies. If a manager, for instance, allocates more than the prescribed amount in real estate, there must be a justification. And if there is no justification, then if the recommended act is to let that investment manager go, then that manager is out. No two ways about it. But the enforcement of the policies of the investment policy in the investment policy statement is very, very critical. I'm going to go through now. I touched on this a little bit. Endowment ultimately is you have a pool of money, you want to manage it for perpetuity to meet a predefined goal. I've given some examples from an academic endowment of their goal, but there's so many different factors that kind of come in play that influence the governance and the operations and the success, likelihood of success for that endowment. If you start with 1 million and you mismanage it, and there's very little money left for the size, you will not be able to meet your spending goals, because you want to be able to continue to meet your spending goals and have it stable and predictable over the long term, right? So some principal factors that will really affect your endowment is, one, you have the initial contributions. You are expecting to get maybe additional contributions from donors, possibly annually, that are aligned in those goals that are already predefined by the investment policy in the IPS, by the investment committee. Those contributions will come in. You will have the investment performance for the pool of capital or financial assets that endowment currently has. How do those assets perform over the time billion, over the long term, over the medium term, over the short term? That, of course, will influence how much you spend on an annual basis. Then the last one is the third one I will mention is, of course, the spending policy, which says how much of the total market value of the total assets of the endowment do we take every day to help pay for the things that we determined are important or of value to us. There is inflation, which of course destroys wealth slowly over time, because a dollar yesterday is not the same as the dollar tomorrow. So you have to keep that in mind as you think about investment performance return. So you'll hear me say the word, inflation adjusted returns or risk adjusted returns. Those are really trying to quantify both market performance of your assets and understanding if inflation is 3% today and we only earn 3%, we really haven't moved the needle, because we only brought our dollar to parity today. Market volatility, of course, is really, really important, because if you have a pool of assets and you over allocate them into one sector, say commodities, which are very volatile, and oil prices, for example, go down, then the total size of that investment is going of your endowment value is going to go down here. So you need to really factor that in as you think about holistically the entire portfolio based on the asset classes that we have. There are two competing goals of an endowment. One, you have set a pool of funds and you said, okay, I want to be able to spend some money out of this every year. But that money that you spend out of it, you have to understand that you have to increase that money over time, because you want to adjust for the spending goals for inflation. So, and you also understand that the total portfolio value of your endowment is going to change based on the performance of investment performance. So how do you set a spending policy that ensures that, adjusted for inflation, adjusted for annual volatility in your investment performance, that you are still able to provide stable and predictable distributions from the endowment to help meet different goals? I'll go through some examples of endowment, but quickly, I'll go through them later, but just an example is Yale endowment for the Yale University or Harvard University or Harvard Management Company. They allocate millions and millions of dollars to help pay for R&D for the school and also pay for education and scholarships for the school. If endowment performance suffers too much and they're only able to do half of the scholarships that they did this year, then it's going to impact the school's rating. It's going to have a lot of bad impact on the long term. So overall, I think the takeaway is you want to ensure that the spending, the distributions are stable enough, because spending policies for operations cannot be subject to volatility, as you will see for similar to your total endowment size. So spending policy is one of the really, really critical things, and I'll dive in a little bit more detail on this. And I've touched on the second one, of course, is to preserve and really grow the capital above inflation. All right, so investment policy statement quick thing is Dr. Dumosu had asked us Santos Labs to help with constructing this. I'll go through some of the key things that are covered in the investment policy statement, which is really defining the goals of the endowment and the objectives, and providing guidelines for investment managers. But he also touches on the investment philosophy. When people say investment philosophy, we're really describing do you want to think about, do you want to get rich quick or do you want slow and steady? That's the best way to really summarize investment philosophy. And are there values that the organization wishes to shy away from? You know, for instance, a lot of schools are thinking more now on ESG, environmental, social, and governance, right? And they're thinking, okay, I want diverse investment managers. I want Black managers, not just all white. Or I want to stay away from oil and gas investments because of climate change, right? Those are examples of investment policies. Or I want to stay away from crypto or Bitcoin. I don't want that in my portfolio yet. Those are, because I don't want to take on too high risk asset classes. So those are examples of investment policies. And those would be well-defined and clearly stated in the investment policy statement. The good thing, of course, as I mentioned, is that Santos is helping draft this, and we will share this with Dr. Dumosu and for the team to review shortly after this call. Okay. The spending policy, this is really one of the most important pieces, and I will share some example. But the spending policy says if there's $1 million in investment, and say today our operations and management, we need to be able to take at least 3%. Spending policy helps accommodate for that. It says how much percentage can you take out of the endowment every year? Because if you take out too much, you will see that it really impacts long-term value of the endowment. Most of the big endowments that I've seen for universities in the examples have about 4 to 5%. That's typical per year. And Yale is an interesting example where I shared you want to have a stable and predictable spending annually. They have this concept of smoothing that out by saying we'll take 80% of whatever we spent last year plus 20% of whatever value we have now times 5.25. So that really says that it's tied to how much most of the money that they spend this year is tied to how much that they spent last year, not tied to the market value of the endowment. And how that helps is that if you have an endowment today that, let's say, it's a 1 billion endowment, and then it falls 10%, now you have 900 million. If you pin the 5% out of 1 billion and 5% out of 900 million are going to be two different factors, and operations cannot be subject to such fluctuation. So to help smoothing that out, Yale has this example where the spending policy is heavily attributed to whatever the expenditure was from last year. And that helps ensure that, yes, the endowment value might be fluctuating due to market performance, but spending policy or the distribution from it is quite stable and only grows based on anchor to last year. I'm going to give some examples now of the effect of spending policy because we kind of give, say, 4 to 5%. Okay, what's a good range? This graph shows one thing. It shows if you started with a total endowment value of initial deposit of 100,000, and we assume that this endowment is growing 8% on a long-term annualized basis over the long term on a year-to-year basis, and that the distributions from these endowments are always going to be at the end of the beginning of the year after the first year. So if you started the endowment this year, then the first distribution will come out in 2025, January, right? Also on and so forth. This graph shows if you have a 4% spending policy, remember you're growing your money at 8%, right? But you're taking out 4% out of it every time. That in 40 years, you will have, say close to $470,000 or close to $500,000, starting with 100 in 40 years, right? At 8% annualized returns. But if you took that 4%, and that's if you took out 4% every year, right? Growing up at 8%. But if you took that spending policy and made it, instead of 4%, you made it just 4.5%, you can see at the end of 40 years, the total money left in the endowment, assuming flat growth annualized rate of 8%, is going to be significantly less or smaller, right? In this case, $84,000 less, just due to the extra 0.5% percentage points in spending. If you took it to 5%, it's going to be even much more less, about $150,000 less in total value at the end of a 40-year time mark. If you took it to 6%, is even, of course, it just keeps going down. So the spending policy target, or the spending policy rate, is really, really important, because if you overspend on the endowment, then you fail on the perpetuity factor, or the long-term bursts that you're trying to meet for the endowment. It might feel good now making those adjustments, but over the long term, it's ultimately going to hurt. And that's what this graph is really trying to show, that every minor 50%, we call it 50 basis points. 50 basis points is like 0.5%, or 100 basis points, 1%. Every single small change can have a negative impact on preserving the endowment for the long run. I give this example again in a different way. Say you started with 100,000 by year 10, a 4% spending policy, growing at 8%, but spending 4% every year, will have about $148,000 left in it. The 6% one, we have about 18% less money in it compared to the one that is only spending 4%. If you look at it on 20-year basis, a 20-year basis, the 4% spending policy has $219,000 left in it. But now the 6% spending policy, we have 32% less money or total value in it over the long term, because you're spending and depleting the endowment at a much more faster rate. So I understand the goal of the endowment that the team is planning now, but my review on this, my initial recommendation is to make sure that the spending policy is flushed out, so that the initial years allows for more growth on accumulation of wealth, right? Instead of depleting the wealth before we get an opportunity to actually grow it. The second important factor, in addition to spending, is really the effect of purchasing power erosion due to inflation. I've touched on this already initially. Inflation, you've probably heard about it on the news today. US inflation just released recently was at 3.4% in December. We're going through years after years of really low inflation to now high inflation coming out of COVID. And we're now on the disinflationary part due to COVID effects and its disruptions to supply chains and global trading, right? So in terms of endowment management, one of the key things to ensure really is that we're using the appropriate measure for measuring the erosion of purchasing power. The inflation measures that you'll hear on the big news or the headlines from CNN and Wall Street Journals talk about CPI, which is coming from the BLS department for US. And that really focuses much more, the CPI stands for Consumer Price Index, and that really focuses more on everyday consumers, how they spend their money and what matters to their wallet for everyday people. But if you're setting up an endowment for education, then the daily expenditures of every individual is not reflective of what the academic expenditures are going to be, because we know schools cost more, or cost of education is rising way more faster than that of personal inflation for everyday people, right? So for higher education, there's a concept of higher education price index, HEPI, that might be appropriate to ensure that the distribution of funds adjusted on an inflation basis are accounted properly instead of using the generic CPI or personal consumption measures that is typically reported on a day-to-day basis. For businesses, you have PPI, producer price index, that says how much are the goods that they're buying to make goods costing, and for the broad economy. So depending on what your target is, you want to ensure that you're properly evaluating the erosion of your purchasing power. That's really what this is touching on. Second point I want to make is that the endowment plan now is, my understanding, is a nonprofit in the US, right? The organization is nonprofit in the US, but it's to support an academic institution in Nigeria, IGS. Now, which inflation measure do you use? Nigeria inflation, right, is double digits, is significantly worse. Is most recent one, if you look at CBN, is about 28% or something like that, right? Compared to the 3-4% range that we're seeing today. And on top of that, you also have the currency effects of changing, if you're going to be denominated or your assets in USD, or currency effects of changing them to Naira. Naira last year fell 52%, so you have to make up 2.2x just to be on a parity rate or parity nominal value due to the devaluation of Naira, right? So in factoring the ultimate and end goal of the use of capital or the use of the resources from the endowment, we want to make sure we are properly measuring inflation correctly. And we also want to make sure that we're factoring all the other factors that might come in play for the target school, in this case, IGS being Nigeria, and the currency effects of the region. I'll go over now and touch on the investment management of the endowment, but I do want to take a pause and see, Mr. Luwani, do you have any questions for me, or have I covered the nature of the topics that you wanted me to get through out of? Keep going.
Yes, I think you're hitting on all of the points that we will be looking for, but I'll wait for the end of the presentation and see if maybe people have questions.
Okay.
I am going to have questions at the end of it.
Okay, sounds good.
So can I just put in something? Do you? I just want to have an idea. What happens if you're going to have 0% spending policy? How does that pan out? You're saying 4%, 5%. Is it possible to have 0%?
0% spending policy says just grow the assets, but not really distribute it. So if the goal is for academic excellence, really you're just putting money in the bank and not distributing it. You have to spend those financial resources, right? So it's practical to do that in the first few years to help accumulate or accelerate the ensure proper preservation of the capital as you grow, especially if you're starting from a small nominal value. But it's not realistic it defeats the purpose of meeting the goals of the investment of the endowment in the long run.
Yeah. All right. Yeah. Okay. Thank you.
We go through asset classes. An endowment really says, here's money. I want you to figure out all the different ways to invest it. My ultimate long-term goal to perpetuity, really, really long-term, or close to perpetuity, is 8% returns. You can go and look at global equities, but if you go through those half cycles where they're good and cycles where they're bad, right? A global financial crisis, the dot-com bubble, you can keep going back and forth, and you find all the different cycles or business cycles where that particular asset class didn't perform well. You can also look at fixed income, which is really bonds or lending money and getting a smaller rate. So global equities are typically on the high end of the risk reward bucket, and the fixed income is on the lower end, but allows more stability. You can also look at real assets, right? Real estate, infrastructure, commodities, natural resources, and you can look at cash. I especially left off Bitcoin here because policy changes are still kind of digital assets, because those are still being caught on. They're not very popular in endowments yet, right? But the goal of this is, if you take all the different investment or asset classes that are available to you, and you understand the cyclicity of the fluctuation of their performance over the time, how do you then invest so that if one is rising, you ride the wave off, but if one is falling, you don't suffer, the endowment doesn't suffer too much just because it's over invested or over allocated in one asset. And you've heard the concept of diversification over and over again. And this is really putting together uncorrelated assets. And we say uncorrelated assets because if you put things that move closely together and they fall closely together, you haven't really solved that purpose. But uncorrelated assets allows you to manage your risk so that if things fall, you have one that might be doing a little bit better that helps you hold the water up and hold the investment value up. So uncorrelated asset classes really help reduce risk and help you preserve capital in the long run. The preservation of capital, I really can't stress this enough. It's very asymmetric in nature. If you lose 1%, okay, maybe you didn't add any more money, or lose 1% of $100, you still need to say about 1% to get it back. If you lose 10%, you need about 11% to get it back. If you lose 20% of your $100, you need 25%. If you lose 50%, you need to make up 100% just to make it back, right? If you have $100, you lose 50%, you fall down to $50, and you need to make twice that amount, or this is 100%, just to come back up to $100, right? So this management of risk, I say, is very asymmetric and is really, really critical to not get too greedy and define that properly in your investment philosophy, right? Because yes, you might have a nice few good years, but if things really get bad, you could lose a significant chunk or all of the chunk of the capital and that will hurt the endowment for a long, long time. The history is littered with endowments that have done this and overallocated in one asset class and really suffered because of this. For this particular endowment, right, for IGSOSANA, there are some asset classes that I believe that will not work. It's a non-profit already, so municipal bonds for savings it helps you save a little bit. It has some tax advantages that helps you save a little bit. It's not really appropriate because we don't care for saving, because most of the earnings are going to be untaxed anyways because it's a non-profit, right? That's the benefit of having a non-profit, both at state and federal level. And there are some asset classes that are also less liquid, and depending on the size of the endowment, require really high minimums, right? If you have a sub $1 million endowment, then going to hedge funds that require at least $1 million to get in makes no sense. And same for private equity. So I just kind of scratch those out. But this helps kind of prescribe, hey, if you're thinking about defining your investment policy statement on which asset class should be put, how much percentage should be put in asset class, there might be some that are not appropriate for this particular endowment, because you don't need the tax advantage benefits that municipal bond offers. You don't really, I imagine, don't need the initial lack of liquidity that some of these asset classes may not offer. And to help explain what I mean by liquidity is, I give someone money to invest, and I say I want to take it out. I want to be able to get that money next week, not 10 years from now, 5 years from now, next week, right? So highly liquid investments will allow you to easily come out of that asset class and have cash, versus less liquid ones that really have maybe restrictions on when you can withdraw it. You can withdraw it for the next 5 years, so it's locked. Can't do anything about it. So less liquid instruments. So that's what I'm referring to there. We'll touch on returns by some asset classes. A lot of the investments that Xanthos does for US based. I mean, US is really the pillar for monetary policies around the world. Dollar is the reserve capital for most of the world. 50% of world trade is based on it. So we focus much more on the highly liquid unstructured financial market or capital markets of the US and tracking those and having indices to measure those. If you look by asset classes, US large caps, which are really big stocks as measured by S&P 500 index over the 10 years, have returned 12% return. But the major thing in economics that everyone will tell you is higher risk, higher rewards, of course, right? And the volatility, which is the fluctuation in year to year of those returns, is about 15%. So maybe on average, you're making 12%, but expect some years are going to be really negative, as we saw in the financial markets in 2022 for US stock markets. US stock markets are measured holistically for everything. That's still about 12%, 15%. World stocks, as you go to much more, includes most developing country, 9% and 15% return. Cash is on the low side, right? High yield bonds, as I mentioned, is much more stable. At the time of making this presentation, I wanted to make sure I included as of December 2023. So the ones that have dash means that they didn't have the volatility numbers reported yet as of the time of this presentation. So just keep that in mind. US small stocks means investment in smaller US companies as measured by Russell 2000 index. So those are companies that may not be available tomorrow. So the returns are okay if you invest right, but on average is 6%, but the volatility is higher, 20% compared to 15% for the Apples, the Googles of the world. Okay. Real estate, 7 and 18%. And real estate is referring to US real estate. So I alluded to this a little bit earlier, that you have all these asset classes. And one of the things you want to understand is, and they don't always all perform well at the particular time. So as the investment committee prescribes the asset allocation policies, they need to understand, have a sense of an economic outlook. Economic outlook says, okay, say today, we're coming from a high inflation time period to a period where inflation is falling. So we need to understand which assets classes do better based on, okay, a lower inflation period and growth is okay. And growth in this case means, economic growth overall, how our business is doing, how are things doing. So what you will typically see here is that real assets, right, real estate, commodities, those really do well at periods of high inflations. And the way to think about it is like, these are must-haves, right? You can't do away with oil because the businesses still need them. So even if inflation is high and growth is low, so you can't go take a lot of risk, you need to still invest in those. Same for real estate. People always need houses, right? But if you go to like fixed assets, you can think about those as, okay, I can invest in those at the periods of low growth time period, right? Where you can get a lot more reward for the risk you take if you invested in high risk asset class like public equities or hedge funds, right? I showed you equities like US stocks being at the top on the risk reward table. But I still want some return because I understand like this is a low growth period. So my expectations of returns is low, but I still want some returns so I can pack some of that money in government treasuries, right, or even cash, just to ensure that I kind of keep something and guess even if it is 1%, 2% or so. So this table kind of shows, hey, if it's a high growth, high inflation time period, maybe we want to put the money, some in equities, some in real estate, some in natural resources. If we're going to like this period that we're in now, like a low inflation, high growth period, maybe we want to put the money in public equities, which, as you just saw, I think yesterday there was a record. The S&P touched a high, right? Like we're coming down from high inflation periods of 2022, and going into a low inflation period now, and growth is still okay, right? So having the investment committee's goal is to sort of have a gauge, and there are different ways to gauge where we are on the economy from growth and consumer demand and inflation. And then there are different ways to also gauge where the asset classes might be doing well and where they might not be doing well. I understand now that I'm at 45 minutes mark, so I'm going to try to go through a lot of the slides that I have a bit quickly. These are now kind of going through examples and touch on the key things that I've already hit before. So I try to just sort of summarize it so we can give at least 10 minutes for Q&A. Okay. The outlook today, this graph shows what the same table as I showed before, but says, hey, we're coming from high inflation. We went almost to 7-8% inflation in the US, and now we're at 3.4%. So we're going from this high inflation, still high growth region, to now a low inflation and still a high growth time. So this blue graph just says this might be a better area to park money versus trying to put the money here or trying to put the money here, because this is where we are now in the economic and business cycles for the economy globally. Right? US real GDP is still 5% as of Q3. Q4 numbers are yet to come out. Some real examples. This is Harvard. I just showed in the last graph that we're low inflation, high growth, and it makes more sense to put the money in public equities, private equities, and hedge funds. This is exactly what Harvard is doing. As you can see here, 11% in public equities, 39% in private equities, and 31%. And then real estate is to have some, but it's not that much. This is called the asset allocation policy, and it's well defined in the investment policy statement that is prescribed by the investment committee. We'll go through some examples. Top endowments of the world that are academic focused. UTIMCO has about 70 billion. UTIMCO is a Texas universities, Texas A&M, University of Texas Austin, where I got my MBA from, and so on and so forth. They have one of the biggest in the world. Harvard as well, almost 50 billion, and Yale 41 billion or so in assets, their endowment. Some quick facts about them. Yale, 1973, so very long, old as well. IGS I was really impressed. It's like 110 years or 111 years old, right? But we have to start somewhere. And the AUM for this is really in the billions and billions of dollars. Their payout ratio, their spending policy, as I talked about before, is typically 4 to 5% range, but you can see Yale has a 4 to 6.5% band. But I gave you the example of the Yale model. Harvard is 5 to 5.5%. UTIMCO is 3.5 to 5.5%. The long-term target return, Harvard is the only one that shared theirs, is 8%. And overall, they've been really doing well by allocating and moving money in the right place. And Yale has the best 11%, and Harvard and UTIMCO at 8% return on an annualized basis for 10-year, 20-year, and so on. Yeah, recent asset allocation policies. I gave the example of Harvard 2 slides ago. It's still, you will see the same being followed by UTIMCO, maybe different percentage weights, as you can see UTIMCO, but it's still heavily on that economic bucket of low inflations, high growth expectation for putting money in public equities, private equities, and hedge funds that I just showed. So this is how the really, really big institutions that run endowments today are doing it. So to put it all together, the key takeaways, we have to ensure that we set up a proper governance. A mix of experience really matters here. We have to really define the purpose and the goals and prescribe that in an investment policy statement that all the investment managers have to go by, and the policies have to be really enforced for the long term. Right? So having that in investment policies is really, really crucial. And for execution, right, that have staff or fund of the staff that will help track the performance. If a manager is not doing well, take them out. If something is not working right, ensure that we tilt the boat in the right direction so that we don't crash in the long term. And really, I think this is probably one of the most important pieces. Is the whole idea of this is to make an impact. How do you quantify that impact? That is up to the committee to measure. Right? How do you, we want academic excellence. how do you measure excellence? How do you be purposeful and measure the impact? So I'll pause here. Thank you guys so much for having me, and I hope you'll learn a thing or two, and I'll pause now for your questions.
Okay, there's some questions on the chat. I don't know if you want to take those ones first.
Yeah, we can take those ones first. For instance, Dr. Dapo Odumos is asking if, Dapo, go ahead and ask your question.
Yeah, good morning, everybody. I hope you can all hear me.
Yes, we can.
Yes, yeah. You know, when you talked about real estate, and I know it's one of the portfolios that could be in the investment. So I was thinking, could one get directly involved in real estate with the endowment funds?
Yes, absolutely. Big endowments do it all the time. They have a lot of properties globally around the world, right? Or they invest through funds of funds that have managers that do go manage especially on REITs or real estate assets.
Yeah.
Of course, real estate can be capital intensive, so it depends on the size of the endowment. Yes, I will prescribe it.
Yeah.
This what I say depends on the size, and the endowment is if you have 100,000 endowment and you say 8% is or 10% is in real estate, that's $10,000. It might not be enough, right? But if you have $1 million, then it might not be enough. You can do REIT funds, but if you have $1 million, then you can do much more, buy an existing real estate property and manage it that way. So I think even within real estate, yes, you can do it, and what you do depends on how much money you have. Yeah.
Sorry, thank you very much. The reason why I asked that question is because I have an experience in this, and I believe that there are some other grammarians who are well experienced in it. And I think it's a very lucrative venture if one manages it properly and if you have enough capital in it. Thank you. I think you've answered my question. Thank you.
Okay, we go to Zeus Williams.
What did you say?
Zeus. One of
okay.
our members wants to ask a question.
Yeah, good morning, or afternoon, mommy and daddy, and everybody else. I had a few questions. One of my questions was I wanted to know what would be your average return on investment over the last 10 years, if you don't mind sharing it with us, if it's not confidential.
Yeah, no, our returns on fact sheet is not confidential. It's public on our website. We've been doing this. Xantos have been managing really long only. When I say long only, we don't short stocks, and that's a bit difficult to explain. But think about it, we buy stocks mostly from it, right? And we did this since 2018. 2016. And our average returns is about 11%. Yeah, on an annualized basis. So we don't have a 10-year track record yet. We're getting to 10-year track record, and we're at 11% on an annualized basis.
Okay, thank you. And the other question I had was, what is your average expense ratio?
Clients today pay 2% or 5%, but we target mostly that's retail clients or everyday people, right? We've done 1%. It changes, and it changes on a upper client basis. So average expense ratio, I imagine you're saying, what are your management fees? And today is 2%, and most hedge funds are 2% and 20. But yeah, that changes really dependent on the clients that we're going for.
And it's negotiable, I believe.
Yeah, exactly.
Yeah.
Okay. That's
Yinka Okwoga. Okay, we can't hear from him. Maybe the president has some questions, I think.
No, the IPP, the Dr.
Hello? Are you hearing me now?
Oh,
okay,
yeah, we can hear you now.
Yeah.
Okay, came alive. Okay. My question is just asking about the minimum level of investment to justify the basic management fee, because we intend to start from the lowest level where possible. Thank you.
Yeah, so This is not a problem, honestly, as I spoke with I think, so frankly, for me personally, Xantos manages money mostly for retail clients. We're focused much more on like building a strong financial security for everyday people. And I'm very, very much more mission aligned with the goals of this organization, just from what I've learned. Like, this is what I want to do in my career, right? So in thinking about it this way, I think all of this can be discussed offline, and I don't see this as a big issue. We have to do something. We have to, like, I shared with you examples of schools that have billions in sovereign wealth funds, but Nigeria's sovereign wealth funds has what, less than 2 billion in its endowment. We're not investing in our future, and we have to start somewhere. We have all this talent, so we have to start somewhere. So to answer your question, I'm not thinking about this right now. We have to help the team achieve the goal, and that's I'm mission aligned on that much more than thinking about the money. Yeah.
Another way to ask that question that I was going to ask is, I mean, in your own experience, this is not tied to your fees or anything. What would be reasonable in terms of the amount to start with? Can we start with $50,000? Does it have to be 100,000, 200,000? What makes sense in terms of before we start on this? Should we raise up to a certain amount of money at a minimum before we start?
No, I think.
Okay.
I think 50,000 should be more than enough to start. The most important thing is not putting issues like, oh, I need to have this amount to start. I think that's what keeps hurting us as a people, right? So like, we need to start somewhere. Let's make all the early mistakes.
Okay.
Right. And that's really the most important. Yeah.
Okay. All right.
Dr. Lani.
Yes, sir. Can you hear me?
Yes, we can hear you.
Yeah, I have a question along the same line with Dr. Kuoga. Given that for the kind of investment or I mean, we cannot compare ourselves with the Harvard and the Yale of the world, and perhaps as you just rightly alluded, probably around 50,000 might suffice to start. But also, I have two questions concerning that. Do you have model portfolio tied to risk and expected return that can fit her purpose? And my second question is that, assuming I tell you that, okay, I come to you and I tell you that maybe I want to leave $50,000 in perpetuity for my children or for my family, will you advise me to put that money in an index fund or in a balance fund, 60 to 40, however I might want to structure it, so as to minimize management fee, or simply buy an ETF fund that the management fee will be infinitesimally small? How will you advise me to go? Structured portfolio and taking into consideration the amount of money that we're thinking about, which pathway will you suggest or recommend that I take? Thank you, sir.
So, sure. Great question. Thank you so much for asking me that, Mr. Bayo. The first, to answer the first question on the minimum amount, I think I've already touched on that already, but I would say start somewhere, right? 50,000 should be more than enough for an endowment, and to sort of figure out the spending policy and the organizations and operational issues, inertia initially, and have experience in that, say over 5 years, right? And then raise even more given that experience, right? So you can better manage it. So I think 50,000, just start something small and start doing. That's the first part. The second question you ask on the structure or the nature of the portfolio that has to be constructed. For personal, you can do an index fund. There's nothing wrong with that, right? One of the reasons why we set up Xantos is index funds, at least historically for us, as maybe it's getting you 8 or 10%, but we wanted to grow our money a little bit faster, and we believe that we can put together a team that can help us do that, right? So that's what we went for setting up an investment advisory service that does exactly that. How we do over the long term is questionable, but we'll see. But to answer your question, yes, you can do an index fund if you're okay with that 8%, that it helps meet your personal goals over the long term. And like, for your kids, like, okay, well, I don't know what the time horizon is going to be, 10 years, 20 years from now, that 8% on an annualized basis is more than enough for me, right? But for endowments, most of the funds, the structure of management comes in the allocation policy. Most of the funds are actually mostly invested in an ETF, unless you have the really big ones that go out of hedge funds and the right checks and so on and so forth, right? But for the endowment of the size that we're thinking now, it would be mostly on index ETFs or so on and so forth. So, because the capacity to manage it on an active basis will only solely be tilted more on how much percentage should we put here. And you do that very infrequently. And then you just leave the ETFs to run. Yeah.
Yeah. Before we go to Mr. Polari, I just have an advice for Dr. Bayolani. Instead of putting the money in your family equity, you should give the money to IGSOSANA, please. And I think we should charge you for asking that question on this platform. Mr. Folari, go ahead. Or Mrs. Folari, I'm not sure which. Are you there?
Yes, boss, I'm here.
Okay, good. Go ahead.
I'm Mr. Yes, I quickly want to appreciate the convener of this program. It's well laudable. Number one, I quickly want to draw attention to the fact that we are not for government organization, NGO, not for profit organization. And recently in Nigeria, I'm aware that there are some legal framework that are not so friendly with operations of the NGO, most especially that are inconsistent with some of the NGO's policies as far as investment is concerned. So I want to know if we have any provision to streamline the project in view with legal framework as they exist in Nigeria with particular reference to NGOs. So that's number one. Then number two,
okay.
Is my question clear?
Yeah, it is. Go on.
So number two, I come to realize that NGOs in particular have peculiarities, most especially its leverage on volunteerism. When people render services on voluntary basis. So, and I look at the program as it has been presented as a very complex in my assessment. It has a lot of simplicities, but as a whole, it looks very complex. So do we have possibility to automate such that at any point in time, all the recommendations are monitored, and we don't have a situation whereby some operators are not even aware of their limits, and probably you made mention of a spending policy that you should sometimes 4% or what have you. So wouldn't there be a situation that people are not aware, or they don't have any mechanism to check the limits?
Yeah, so to answer your first question, I apologize, but I wouldn't be the best person to answer that. The legal frameworks of Nigeria for NGOs it's not my wheelhouse, and I'm sure someone here is a lawyer that might be able to better help set up and show those operations. But for nonprofits in the US, it's really very straightforward. I don't see any challenges for the not America organization of this institution to be able to run. The interlay would be, of course, on how does it work with the sister organization in Nigeria and navigate the legal challenges here. So someone will have to take that. The second part of your question is actually very much my wheelhouse. Managing an automated investment management is what Xantos does, and that's what we do day to day, and even our back office is fully automated. So I think that's something that we can lend help to help set up that operation and help make some recommendations in the way to ensure that it runs efficiently, even in the absence of key personnel. Of course, not to delegate all the work to some machine somewhere, but yeah, that's something that we do very well. Most of our trades and of our client accounts is all automated and trade.
We'll have one more
Locations that you see
question
are
from Dr. Lanion.
I think it's the hold hand.
Oh, okay. It's an old
That
one.
is, yeah, it's an
All right.
old one.
All right. Polani is also an old one. Well, I think
Yes.
we should call it a day.
Oh, I have a question.
Sorry. Go ahead.
Yes. Regarding the investment policy statement, I know you would have come up with that at the beginning, and I know you said it can be updated on a regular basis, probably quarterly or whatever it is. But in a certain year, if we have this policy that you have already set up for us, do you still go ahead to take a look at it, even though it's probably not time yet to update it, and you see that some of the funds that we have invested in, they're losing ground and we're losing money? Can you quickly adjust?
yes.
Okay.
So the policies make prescriptions of weights. Say I want public equities maybe 15% to 20%. It gives you a range.
Yeah.
It doesn't, and that range allows you to adjust, right?
Okay.
But if you still want to go and make, the committee will come together quickly and say, hey guys, based on everything I see, these wars are going on, we need to hunker down, right?
Okay.
Let's pull back all up. So you can make
and
those
that can be done at any time. We don't have to wait to say because we have said quarterly or annually before we can.
Yeah.
It can be adjusted at any time. Okay.
Yeah. The key word is at least quarterly. Yeah.
Okay. All right then. Miss Dr. Lanion, are your hands still up? I mean, is your hand still up?
Looks like an old hand.
No, it's an old hand. Yes.
It's an old hand.
Excellent presentation. Yeah.
Okay.
It's an old man's hand.
From an old man.
Okay.
All right. Okay. Any other question before we call it? Okay.
Yeah, I had a question.
Okay, go ahead, Zeus.
My last question would be, how does Center select its account managers? On what basis? If it's something you can disclose as well, if you can, I understand.
Yeah, so Xanthos is an investment advisory firm. If you remember the diagram that I showed you here, I said you have a team of investment managers that we manage money for the team. So talking to Dr. Dumosi, understanding where this organization is at now. Typically, you have a consultant that would say these are different managers, right? But paying for a consultant is in itself almost $100,000 a year, right, for big endowments. So we're just a manager. We focus on stocks only, but we're coming in now to help with the investment policy statement drafting and helping the setup operations. So we are a single sole manager, right? And I'm the chief investment officer for Xanthos, and we don't select account managers because our team is the manager itself. If that sort of answers your question, right? Right.
Yeah.
So the question you ask would be much more for investment consultants that go in and find all the different managers. Hey, I want a private equity manager, I want a real estate manager, and so on. Right. Yeah, that's not what Xanthos does. Xanthos is one. Yeah.
Okay.
I have one more question, but before then, Dr. Okuwaga, is that an old hand?
No, it's a new hand.
Okay, go ahead.
It's a young hand. Thank you very much, Mr. Presenter. My question is just in respect of our risk appetite as to whether there is the likelihood or possibility, remote or otherwise, of our assets going into negative. Because all I've seen so far, unless maybe I missed some of part of the presentation, was that an increase or possibility of returns of 10%, 5% kind of range. So if you can shed a little light on the possibility of our assets going into the negative, especially our capital. Thank you.
Yeah, so most of the returns that I shared here those are gross returns, right? They're not after fees, and they're not even adjusted for inflation, because that's a very difficult math to even easily execute. But if you account for inflation, right, you will start seeing some of these much more on the negative. So if you set an 8% target return adjusted for inflation, adjusted every year, you will start seeing the asset classes change. And the volatility I also mentioned, this is on a 10-year basis. That's on average over 10 years. But some years are going to be negative. I mentioned that for US stock markets, for instance, in 2022 was negative, right? 2018 negative. So there are some negative years, right? But overall, you hope that everything will lift up a little bit. Investment involves risk. I shared that initially. I said past performance is not an indicator of future returns, right? And I mentioned that as well initially. And I think the risk appetite has to be, that's all comes in the portfolio construction, to ensure that you build a structured portfolio where you don't, yes, things can fall negative, but over the long term that you hope you do well, right? And that's been the case for most endowments. But if you don't manage it well, maybe you select the wrong thing and put it all in one asset class, it can be negative and it will stay negative forever. Yeah.
My father founded St. Jude Children's Research Hospital.
Thank you.
Okay, I think we can call it a day. I just want to, what I said at the beginning about the pudding being in the eating, I think as far as I'm concerned, I have had a very good pudding today, and the product has been very delicious. I don't know about you, but I'm sure for most people that is the situation. And I would like us to show our appreciation to Mr. Chuck Orakwe by giving him a round of applause. I hope you can hear that. You can hear me now, all of us.
Thank you so much.
Thank you all so much for having me.
Yeah.
I will send the slides to you, Dr. Dumosu, so you can
great.
share with everyone else.
Okay, thank you for that.
Thank you.
All right.
We can excuse Mr. Orakwe for now, and I don't know if the president of the association has some family announcements that she wants to give us. She can go ahead now and close the meeting.
Oh, okay. I mean, I don't have any announcement, unless maybe once Chooks is out of here, if maybe for the sake of us in the family or in the IGSOSANA community, we have questions.
Yeah.
If you have questions for me, for example, or for Dr. Dumosu, we can take it now, or we can leave it for another session that we can have. Since you are all here, you can start asking questions about how we intend to do this with IGSOSANA, everything that we've just heard. Any question for IGSOSANA?
It's time for you to try next.
Yeah, please. Can I ask a question?
Yes.
Can I?
Yes, go ahead.
Favorite bra today?
Go ahead, sir.
Okay. Ola, are you hearing me?
Yes, we can hear you. Go ahead, sir.
Oh, I've had a lot of problem. Yeah. The question, it's not, I don't know whether it's a question or it's a comment.
Mm-hmm. Yes, go ahead.
Okay. I wanted to know, does that company operate in Nigeria?
No. They're here.
Okay.
Yes. For the Nigeria part of it, I think we've decided we're going to be using Stanbic Bank. So Stanbic Bank will take care of the Nigerian part of it. We're working with them. Yeah. All right. Any other question? So really, what we are planning to have is to have a US element and a Nigeria element. They're going to be two separate ones. Any money that we even make out of the US one, we're still going to spend in Nigeria. because Nigeria is where we spend all our money on the school.
Right. Okay,
Yeah.
thank you. And bye-bye. Very good work.
Okay. Thank you so much. Any other question? Okay. I think people are reserving their questions for later. Once we put out more information about this, I'm sure that people will have questions. We're hoping, I don't know yet, but we're hoping. We were thinking before we were going to launch this in the first quarter of this year, but we're thinking that we need to educate people more about endowments and socialize this a little bit more amongst the members and launch it at the convention. That is our thoughts, right? That's what we're thinking right now. I don't know if that is going to change. Dr. Odumosu, do you have anything else?
No, nothing.
Okay.
I'm
All
happy
right.
the way the whole thing has worked out.
Okay.
I think Mr. Rakwe is competent, and Xantos will be useful to IGSOSANA.
Yes.
Thank you.
All right. Thank you so much, everybody. Thanks for joining.
Thank you.
Bye.
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 Bye.